Sure, sir. As discussed, financial markets perform the essential economic function of channeling funds from households who have saved surplus funds by spending less than their income to firms and governments that have a shortage of funds because they wish to spend more than their income for creating sustainable value in the society. The most important lenders savers are households in the economy. It can be a saving for their child future education, future asset generation, safe retirement, future risk management. The most important borrower spenders are businesses and the government. In direct finance, borrowers borrow funds directly from lenders in financial markets by selling them securities, which are claims on the borrower's future income or assets. Securities are assets for the person who buys them, but liabilities for the individual or firm that sells them.
Is there any classification of financial markets?
Mainly, there are two kinds of markets. Debt and equity. Let's first discuss about debt market. You might have heard of infrastructure bonds that the government issues to mobilize funds for its public programs. It issues securities to the savers in lieu of the money the savers provide to the government. Securities are papers that indicate the borrower is liable to pay back the savers certain amount at certain payment terms at certain interest rates. The savers keep these securities with themselves and surrender back to the borrower once the promised cash flows are affected by the government. Just like government, other large companies can also mobilize funds by issuing securities to the savers. So, the borrowing entity issues securities to the savers. Saver gives funds. Borrower repays the amount with interest over the tenure of the security. To reiterate, the repayment is not just of the principal but also of the interest. Securities are assets for the person who buys them, but liabilities, IOUs or debts for the individual or firm that sells issues them. Security is a way of mobilizing funds without giving any ownership of the borrowing entity to the savers. That is, it's a loan transaction which gets closed once the borrower pays back the money with interest. These securities are generally called as bonds.
Now, let's discuss about equity market. Under equity market, the firm issues equity stock instead of bonds in lieu of the money raised, which is another type of security. This security has no fixed repayment of the money over time, as is the case with the bond. Under equity issuance, the mobilizing company partakes of ownership of the company with the equity shares owner. The equity owners are called shareholders as they hold shares in the company. In addition, the issuing company can provide for dividend in case it does well. As a simplistic example, assume a company has 100 shares and also issues 100 shares of $100 each to 10 savers to fund its projects. Each saver pays $10, gets 10 equity certificate worth $10 and becomes a shareholder in the company. Now, each saver owns 10 divided by 100 plus 100 is equal to 5% of the company. In case the company is liquidated, the saver is expected to get 5% of the assets worth of money back. In a normal scenario, the company would deploy the funds into projects that increase its cash flows. At the end of 1 year, the company may pay a dividend of 10%, that is $1 to its shareholders. Over time, the value of the share would appreciate in the stock market if the company does well, in which case the value to shareholders also increases even at the same ownership proportion. So, in equity financing, the savers own a part of the company and get paid money as dividend as a percent of the share's value, and capital gain if the value of company shares increase. Whereas in debt financing, the savers do not own the company but get paid interest and principal. Quite innovative ways, I must say. Coming back to debt financing, I understand that some of our citizens may have requirement of a loan for 2 to 3 months, whereas others may require it for 1 to 2 years. For example, our carpenter had made sales to Jim last week, but Jim has indicated that he can pay him back only in 3 months. Now he needs some funds to sustain his operations till Jim pays back. So he needs a loan only for 3 months. At the same time, there is Peter, who is looking for funds for expanding his facilities. By expanding facilities, Peter will be able to increase his turnover by 100% in 1 year and should be able to repay the loan only over the next 3 years through the increased turnover. So, for one, the need is for a small period, and for the other, the need is for a longer duration. How does this work? Can the debt market cater to both of these borrowers? Well, good question, sir. Basically, there are 2 types of markets. Money markets for short-term lending and borrowing. Capital markets for long-term lending and borrowing. So, the carpenter will go into money market for his needs, whereas Peter will go into the capital market for his needs.